In the spirit of following up on risk management, we're going to continue with everyone's favorite topic on internal controls. And I really want to talk to all of you today. Thank you again for those of you who have decided to spend your morning with us. But internal controls are also a great kind of follow-up to risk management because they're so critical for all of your organizations, regardless of size. And so my hope today is that you'll have some takeaways regardless of whether you are working in a really small nonprofit that has maybe just a few employees or even a larger nonprofit with very segmented departments and a little bit more hands on deck to be able to do things. We're going to talk about how you can kind of streamline those internal controls in the current environment that we're in. So I'll just quickly go through the bio for those of you who don't know me. Erin Clark, I am a member of the firm. I have spent my entire career here at SEK, 15 years. And while I did start my career solely performing audits and attestation work, I have also sort of gone off into doing some more consulting and advisory service work as well. My client base has always been predominantly nonprofits, but having more of the consulting and advisory work has really given me some added insights to the everything that impacts nonprofits. And so I feel pretty qualified to be here talking to you guys about internal controls today. And then just a fun little fact, just this week I returned from a trip to Orlando with my family last week. We did a split trip between Walt Disney World and Universal. So I'm still recovering from all of the walking and the hustle and bustle, but it was a good time and happy to be here with you guys. So as I mentioned, the main sort of bread and butter of this presentation is really going to focus on the first bullet point here, key internal controls, what you should be doing, why you should be doing them, why it's so important. And then after we get through that, the last two pieces are talking about the key players, who should be doing what. Again, depending on the size of your organization, I understand that it's really sometimes limiting to be able to do the things that we're telling you you should do. So we'll talk about how you make sure that you get the right people involved. And then the last piece of this is going to be adapting to all the changes. So, this has been a common theme in the presentations you've heard already this morning, but it's certainly no shock to any of us that the last several years post-pandemic have been just a whirlwind of change. And if anything, change continues to just keep happening faster and faster each year. And so as we continue to acclimate to those changes, things like dealing with remote working environments and the increased use of technology, we'll talk about those as well and how those can and should impact your internal controls. So let's kick this off with what you should be doing and why. And I'd like to just start off here with a few graphics for you. So there's an organization called the Association of Certified Fraud Examiners, and they put out an annual, it's called a report to the nations, again, on an annual basis. And this comes from a survey that they do of companies and organizations of all sizes across all industries across the entire world. You can actually do a quick Google search and find the full report and really dive into it and look into specifics across, in different countries, what are the trends, in different industries, what are the trends. So what I'd like to really kind of hone in on is that the graphic on the left here talks about what types of organizations are victimized by occupational fraud. And really the key reason that you want to make sure that your organization not only has good internal controls, but properly implements them and employees actually adhere to those controls is because it's your first line of defense against occupational fraud. And so, again, you can see there's different industries. We've got private companies, public companies, government, and then the second line from the right there in that first graphic is nonprofits. And it shows the green line shows the median loss related to occupational fraud, $76,000. And then the dark blue line below is the percent of cases surveyed that were related to nonprofits. So 10% of the cases surveyed, 1 out of every 10, was a nonprofit organization. And the median loss to the nonprofit as a result of some sort of occupational fraud. So that's basically internal employees either embezzling funds or some sort of fraudulent scheme to defraud the organization, provided a median loss of $76,000. And so I know we've got a lot of folks from different size organizations on the call this morning, but I would really make the argument that not one of your organizations could stand to lose $76,000 just due to fraud. And so again, we're going to be talking about internal controls that you should have in place. And that's, again, that's that first line of defense. First of all, hang on one second, Christina, if you can go back. That's first of all, the way to prevent fraud and errors from occurring, but then it's also the line of defense if something does occur to hopefully detect that. And so that second graphic there talks about how an organization size relates to fraud risk. And I would draw your attention to kind of the top half there, because that first line is organizations under 100 employees, which I would say is probably the majority of you on this call. And then I know we do have a couple of other larger clients that might fall within that 100 to 999 employees. So you can see again on the left-hand side, the percentage of cases, 21% of organizations under 100 employees, 22% between 100 and 999. And then again, you can see the median loss of 141,000 and 130,000. So we're not talking small dollars here. And I just saw a question pop up. What is occupational fraud? Great question. So occupational fraud is some sort of fraud. It could be misappropriation of assets. It could be an internal scheme by somebody within your organization to essentially steal from the organization. So it could be inappropriate billing to try to collect and steal money. It could be writing checks to fraudulent vendors, essentially themselves, to, again, get money from the organization. There's a whole list. It could be check kiting. It could just be flat out stealing. It's literally any type of fraud internal to an organization that essentially allows them to steal money from the organization. And so again, when working with nonprofits where you are all trying to be good stewards of your funds from donors and grantors, certainly you want to protect that money, and that's why internal controls are so critical. All right, Christina, now I'm ready for the next slide. And so this is just a graphic to show that the presence of anti-fraud controls, and it's really not anti-fraud, but honestly, all internal controls, is associated with both lower fraud losses and quicker fraud detection. And in more than half of the cases that occurred in this annual report, this study that was performed, 32% of fraud occurred because there was a lack of internal controls, and an additional 19% occurred because of an override of existing controls. So that means that there were controls in place, but for one reason or another, the employees and management responsible for overseeing that weren't adhering to those controls. And so in over 50% of cases, the fraud most likely could have either been prevented or detected timelier if the proper internal controls were in place and actually working effectively and being adhered to. So if that hopefully doesn't make the case for why this presentation is so important, I just thought that the graphics and some of those statistics would be helpful. I know this slide's a little bit hard to read, but it does provide some more information on what specifically can be done to prevent fraud from occurring. And beyond the two things that we just talked about, lack of management review is another one. So we'll talk about that here when we get to the key players, but making sure that we've got the right sets of eyes on things also helps with making sure that you've got the right internal controls in place. So with all of that being said, let's go ahead and dive into some specific internal controls. And so the next several slides here are really by different areas of your organization, so different processes that you have in place. What I've tried to do is identify what key controls you should be having based on that process. And so the overarching piece or the main takeaway for all internal controls, no matter if we're talking about cash receipts, cash disbursements, payroll, financial reporting, whatever it is, you have to have segregation of duties. And so you'll see that on many of these slides here. But the idea is that whoever has physical access to the asset, whether it's cash, whether it's inventory, whatever physical access you have, there needs to be a segregation of duties between that individual, the person responsible for the bookkeeping, the record keeping, and then ultimate reconciliation of the account. So specific to cash disbursements, that includes first and foremost, you're starting with a purchase order or an invoice, right? You're going to have, whether it's a full purchasing department, or even if you just have one person that's in charge of buying whatever it is that your organization needs, whether it's goods or services, somebody is responsible for for procurement at whatever level in your organization. So having somebody approving either the initial purchase order, if that exists, and the ultimate invoice to be able to say, yes, this agrees with what we've ordered and it is a valid purchase. The vendor is valid. We absolutely made this purchase and it should be paid for with company funds. Having that just basic approval is a critical internal control for any type of cash disbursements. Also having authorized check signers and signing limits. I know a lot of times with small organizations, you might have an individual or even multiple individuals on your board who are authorized check signers because you may not just have the bandwidth in your employees, but having only certain people who can sign checks, especially if it's above a certain amount, maybe over 5,000, maybe if you're a larger organization, maybe that threshold is a little bit higher, but also having signing limits. So perhaps, you based on your risk tolerance, you have a threshold to where maybe your executive director can sign checks up to 2,500, but any checks over that have to have maybe a board treasurer or a board president signature, or maybe needs 2 signatures. That's also a good internal control, again, just to make sure that money going out the door is being paid appropriately to proper vendors and for proper purchases. Credit cards and employee expense reimbursements is another big one. Making sure that you have the right controls in place. Again, going back to the whole physical access, who actually has access to company credit cards? Who can use them? Is it, just sitting on somebody's desk that an employee can walk in at any time, grab it and go make a purchase? Or is it under lock and key and really maintained properly to make sure that there is no unauthorized use of that? If it's an employee expense reimbursement, making sure that they've got proper documentation, perhaps it's mileage, perhaps it's reimbursement for, other travel costs, a hotel stay, but just making sure that they've documented that and that somebody who's responsible for approving the nature of the expense. Again, if they were traveling maybe for a conference, that makes sense. But just making sure that we're only approving things that are truly business related and not personal in nature. Making sure that you've got the approvals in place for both for approving the nature of the reimbursement and also signing the check to the employee are critical. And then as cash disbursements play in, again, cash kind of covers a little bit of everything. So making sure that you're segregating, I'm not sure how many of your organizations still have physical check stock. I know a lot of my clients have moved to utilizing like Bill.com and ACH payments, but if you do have physical check stock, making sure that that stock is also controlled under lock and key and only accessible by appropriate individuals. And again, whoever has that physical access, not just to the check stock, but also the bank statement, who's opening the mail and getting the bank statement. It should be somebody independent from the person doing the record keeping and ultimately reconciling the bank account, because that just helps to have that at least a second, if not a third and fourth set of eyes on things. And then lastly, proper general ledger coding. It's super important that not only do the purchases that you're making have proper approval and making sure that you've got the right people in place to sign checks, but is it ultimately getting recorded in your general ledger properly? Is it being coded to the right expense account? Or if it's, if it's a refund maybe to a customer or a patient, for example, is it properly offsetting revenue? But that's a key control as well, is making sure that somebody reviewing an invoice and ultimately being responsible for entering it into your general ledger software, of making sure that it's being coded to the correct account for good accounting records. So then a lot of similarities on cash receipts. Do you have a cash receipts log? Again, many of you may not have a ton of cash and checks that are coming in via mail. Maybe most of your payments are, again, kind of electronic payments automatically hitting your bank account. But if you do have physical cash coming in or donations that maybe, especially at the end of the year when people are trying to get their tax write-offs in, if you do have physical cash or checks coming in the door, keep a cash receipts log. Have somebody separate that's checking mail be able to log that receipt and then cross-reference that ultimately when a bank reconciliation is being performed to ensure that something didn't just walk off. Again, can't relay enough that segregation of duties between the physical access, the record keeping, and ultimate reconciliation of the bank account. Daily deposits. Again, I know a lot of banks have been offering remote capture to where you may not even have to physically go to a branch any longer. But if you do, make sure that the person responsible for doing the daily deposits is, if possible, separate from the person that's recording those deposits in your general ledger. Not to jump too far ahead, but when we get to the who should be doing what, and the key players involved in this, that's where if you do have a limit on the employees, maybe you can rely on board members and volunteers, but ideally you really want to try to segregate that as much as possible so that the person that is involved in getting the mail and taking the cash and checks out of the mail isn't also the one preparing the deposits, taking the cash to the bank, and then ultimately recording it in your QuickBooks file or whatever general ledger package you're using. It's better to have a couple sets of eyes on different pieces of that transaction. For those who may, hang on one second, Christina, for those who may still have an actual safe, if you are making physical deposits at a bank branch and they're not remote, again, this may be a little bit outdated for some of your organizations, but make sure that the safe has restricted access. I know several years ago, I had a former client that they had a safe in the office and it was sort of just left open. I mean, there were only a handful of people in the office, but it was left open. And I remember finding out that employees would sort of write IOUs for lunch. If they wanted to just grab $10, they would go and grab lunch and then just write it on a little Post-it note, an IOU. I don't recommend that, not a good internal control. And realistically, if the safe had a good physical access, it would have been locked anyway, and only one or two people would have been able to even access it anyway. But that's another key control as well. And then similarly to the cash disbursements, again, proper GL coding to make sure that, if it's a donation, it's properly recorded as a donation. If it relates to a special event, it's properly recorded to a special event, et cetera. So then we're going to kind of step away from cash here and talk about payroll. Lots of key controls that you want to make sure you have in place over your payroll processes. First and foremost, I hope that all of you have some sort of annual approval of pay rates, including documentation of that. Certainly with larger organizations, I know that you're going to have a more formalized employee evaluation process, and I suspect that your pay rate approval is likely tied into that. But even in your smaller organizations, if you don't have a formalized process to document any pay rate increases, whether it's merit or cost of living adjustments, that should really be done on an annual basis and retained in employee personnel files. Similarly, a supervisory approval of time cards. Certainly understand that many of your organizations are at least going to have some employees who are salaried, but for those who are hourly, it's so critical to make sure that there is a supervisor approving the hours, not just the hours that they're physically there, but specifically what they're working on. And that kind of gets into the third bullet point of proper general ledger posting and allocations. With nonprofits, it's so critical to be tracking your functional expense timing to know if you have employees that are working on various programs compared to general and administrative or fundraising functions. And so having time cards or some way of documenting and then ultimately having an approval of, yes, this employee spent 20% of their time this week on fundraising initiatives, maybe 60% on program related services, and then 20% on G&A, because ultimately that helps to provide for better financial reporting as well. And then on a quarterly basis, you should be preparing some sort of payroll reconciliation. One of the most straightforward way to do this is a quarterly 941 reconciliation. So that's taking your payroll report and your 941 that you're filing with the IRS, as well as your general ledger, and preparing a reconciliation to make sure that the reporting that's being done in your general ledger matches what you're reporting to the IRS and also can reconcile to your payroll report. So whether that's whether you're using a third-party payroll processor or whether it's something you do in-house, that reconciliation is a key control, again, just to make sure that not only are the hours worked and the pay rates being calculated at what they should be, and that you're paying people properly, but that they're ultimately getting recorded in your financial reporting software correctly. I do see that there is another poll question that has popped up, so please be sure that you are answering that. And then we're going to talk a little bit about internal controls over just general financial reporting. So we've talked a little bit with cash and payroll about reconciliations, but I can't stress enough how important it is to reconcile all of your significant balance sheet accounts, at least on a monthly basis. I could see a situation, depending on your organization, and maybe if you have some investments with very limited activity, maybe it's just some CDs or things that aren't actively traded, maybe quarterly. But it is absolutely critical that you are reconciling accounts on a regular basis, preferably monthly. That's going to be your cash accounts, your investment accounts, your receivables, your payables. All of those things you should be able to reconcile timely, because if if that reconciliation isn't occurring, it just provides so much more opportunity for for errors to occur, for things to get hidden. When time passes and you forget, what may have happened in a given month that would cause your bank account reconciliation to be off. It's much easier to kind of just plug it into an account somewhere, and realistically, that's not what we want to be doing. So having those reconciliations not only be prepared timely, but also reviewed by an independent individual on a timely manner can help, again, it keeps the controls in place to prevent an individual from committing some sort of fraud, or even just having blatant errors in your financial reporting. But then also, if there would be an issue, that's a critical detection control as well. Review your monthly financials. This is something that your managerial level as well as your board should be doing. And certainly if you have a separate finance committee of the board, they can be more responsible for that. That's going to include basic financials, things like your balance sheet and income statement. Kind of skipping ahead to the budgeting thing here, a budget to actual statement can be critical, especially if you're able to analyze variances above a certain threshold. Again, maybe that threshold is going to be different depending on the size of your organization. But from a percentage standpoint, I usually use a general rule of thumb of like 10%. So if you're looking at a line item that your budget to actual is off by more than 10%, you should be analyzing that and discussing that at your board meetings, or at the very least at your finance committee meetings, to be able to explain variances, and hopefully try to get back in line with budget, or at least acknowledge why you've had to spend more, or why revenues perhaps may be less than budgeted. And then journal entries. For those of you who are audited, you're used to us asking, we have this fun journal entry test that we have to do, and it's specifically to look, not search for fraud, but it's to look for management override of controls. And so the whole idea is that we're looking to see if a journal entry has been posted, not necessarily fraudulently, but maybe without proper supporting documentation that could mean it was posted in error. And also to make sure, again, that there was some level of approval, that the person preparing the entry was not also responsible for having the final set of eyes on that, but that somebody with the knowledge base to be able to say, yes, that journal entry is properly supported. Here's the documentation to verify that. And it was properly recorded to the correct account in the correct period. Having that proper review is a critical internal control as well. And all of those things tie into your ultimate ability to generate good financial reports. And now I want to talk a little bit about IT controls. And while I certainly will not pretend to be an IT expert, again, I think some of this does tie in nicely with the risk management presentation that we had earlier. Every single organization needs to have IT controls in place. And I don't care if you're a party of one, if you have a super small nonprofit and there's one employee, or if you are a larger organization. In the ever-evolving times that we are in, having IT controls has become all that more critical. Again, that relates to physical access to the actual computers. And again, we talked about other items, but who has physical access to your records, your accounting records? Data backups, if that's not being done on a timely basis, you absolutely want to make sure that you're connecting with an organization that can ensure that your general ledger files and all of your other supporting files are being backed up regularly in the event of some sort of catastrophe, that you would be able to access those files. Logical access to things like the accounting software and bank accounts. Who has logins to those? Who can access your general ledger? Who can log in and look at your online bank account activity? I'm sure for larger organizations, there's many other online portals as well, but making sure that that access is restricted only to individuals who need to have that access and not to multiple individuals in your organization is a critical internal control over IT. And then lastly, I want to talk about fraud schemes here, because again, your first line of defense against some of the cybersecurity issues that Chuck discussed is also going to be the key internal controls for financial reporting as well. A lot of these go hand in hand. And we've talked a little bit about, the executive impersonation scams, whether it's spoofing or, another example that we have seen all too frequently with many of our clients is a situation where the finance person receives an email from somebody that looks like it's the president or the CEO or somebody higher up in the organization saying either like, hey, I want you to wire money to this account. And there's usually a sense of urgency to it, right? Like it has to be done immediately and do it now. And here's the instructions. I had another situation with a client where they received an email instruction to change their direct deposit information for their personal payroll. And it was a scam. And so having the right IT controls in place to verify whether that's something as simple as picking up the phone and calling the individual and confirming, hey, did you just email me with these instructions to pay this vendor? Or did you just email me with this change to your direct deposit? I want to make sure that before I go into the payroll system and make that change, that you really did authorize this and that this email really came from you. Because in so many of these situations, it's not. And unfortunately, you don't find out until it's too late and you've already wired the funds to somebody overseas, not anywhere related to any of your operations, or you have paid a so-called employee that's to a bank account that's not even theirs. And so again, I can't reiterate enough to the importance of having the right IT controls as well. And so lastly here for this part of the presentation, again, just I think graphics speak volumes. This is another chart from that report to the nations related to occupational fraud. And it talks about the importance of internal controls in fraud detection. And so you can see here, it's sort of filtered by the largest cases at the top going down to the bottom. But there are some key controls in here that are really crucial in detecting fraud. What I do want to point out is that tip, by the overwhelming majority, is at the top of that list. Tips are not anything related to internal controls. It's just making sure that you have somebody in your organization, whether it's an employee, it may be a customer, somebody who's honest enough and willing to just say, hey, like, something doesn't seem right here. That's not an internal control. It's literally just kind of luck. But as you go down through this list, you'll see things like having an internal audit function can be critical in detecting fraud. Management review, that's absolutely a control, whether it's review of reconciliations, review of the journal entries like we talked about, reviewing financial reports, and not just reviewing them, but asking questions. If they don't make sense, don't just take the word for your finance person or whoever's in charge of preparing those statements, but ask questions to understand, especially if there are account variances that don't make sense to you. Document examination, looking at those invoices that you're hopefully approving and making sure that they're valid. Account reconciliation, again, a lot of really key controls here that are not rocket science, but are just crucial for all of your organizations to have. So with that, again, that was kind of the bulk of the presentation, but I do want to talk about the key players, because so often I hear, oh, we're such a small organization and we only have a couple of employees. We don't have the scale to be able to have the right controls in place. And honestly, that's really not a defense to not having good internal controls. So we can go ahead to the next slide. So depending on the size of your organization, I'm going to make the argument that if you have what I'll call a mid to larger size organization, and when I say that, I mean, let's say that you have more than 2 to 3 people involved in the financial reporting mechanism of your organization. There is likely some accountant or bookkeeper who ultimately should be reporting to the CFO. So if you've got a reconciliation of an account or work that is being done by that accountant or that bookkeeper, and it also, by the way, doesn't have to be an employee. It can be an outsourced accountant, because I know many of you are utilizing an outsourced accounting firm. It may even be our firm. But if you have an accountant or a bookkeeper, then ultimately a CFO could be responsible for reviewing that work. But on the flip side, if it's work that the CFO is doing, their work should also be reviewed. And so that may default to the president or the CEO. Again, just getting that second set of eyes. Your individuals may be extremely competent. They may be the most honest people. But at the end of the day, having the right controls means having a second set of eyes and having independent reviews, no matter how competent the individual is that is doing the work, and no matter how honest and trustworthy they are as well. We can go ahead and go to the next slide. With that being said, though, I do recognize that you may have organizations where maybe you don't have a CFO, because maybe you have one individual that is involved in the financial reporting. Maybe it is the accountant, maybe you call them a bookkeeper. And in that case, I'm going to tell you that you need to be relying on your board treasurer. And if I have board treasurers on the call and you are not actively involved, depending on the size of your organization, in the financial reporting oversight. Certainly for larger organizations where there's a more developed management team and robust financial accounting department, maybe your involvement doesn't need to be as granular. But if it's a small organization, I'm going to encourage you that if you are not actively involved, maybe not in the day-to-day work, but at least in reviewing monthly reconciliations and in reviewing journal entries, perhaps even reviewing credit card and employee expense reimbursements, you absolutely should be doing that if there is not someone internal, either an employee or part of the, if it's an outsourced accountant situation, part of that team that is reviewing that, absolutely be doing it. And if it's something that the CEO or president, depending on how your organization is structured, again, if it's not the board treasurer, maybe it's the board president that has the review on that, because there is always going to be an opportunity for a second set of eyes. And so the takeaway that I want you to have here is that it truly doesn't matter how small of an organization you are. If that means relying on your board more or a finance committee to have the right financial oversight, then that's absolutely what you need to do. So in the spirit of that, utilize your board and volunteers. Again, I talked about with the cash receipts, somebody separate from the person opening mail should be making the deposits. You know what? If you have a volunteer that's in the office a couple days a week, or maybe a couple hours a week, have them open the mail, have them prepare the cash receipts log, and then hand it off to your finance person to ultimately make the bank deposit. Because then at least that way there's been a second set of eyes on money that has come in, that you don't have to worry that somebody slipped, some cash or a check. It's also, again, it's not just about fraud, it's sheer error. It's making sure that a check doesn't go missing. I've worked with organizations where checks somehow vanished after coming in via mail, and having, again, just multiple sets of eyes helps to make sure that that doesn't happen. Making those bank deposits, if somebody is knowledgeable enough to write a bank deposit slip, you can use a volunteer within reason to go and make the bank deposit. Again, if that's how you need to structure the segregation of duties, if you have one finance person and they're the ones doing the reconciliations, you can use your board members and your volunteers to actually do the deposits at the bank. Approving annual pay rates, that at the very least should be your executive director if you don't have a larger, maybe different program heads that are doing that for each of their departments. But again, that should absolutely be segregated. And by the way, if your board is not approving your CEO or president's annual pay rate so that they're not just approving their own, that's another key control that should be done as well. And then also making sure that they're involved in the budget process, because again, the budget is also a critical internal control. And so if your board and perhaps even finance committee more so are not involved with the budget process, they absolutely should be, if nothing else, from a review standpoint and also a monitoring standpoint throughout the year of keeping on track for how the actual to budget is aligning. And so my last few slides here, really, I want to just drive this home talking about adapting to changes in the workplace. Again, it's no secret that the culture that all of us have been working in, whether it's corporate culture or the nonprofit environment, has been changing rapidly, and it's likely going to continue to do so. So I just want to talk a little bit here about how we are adapting our internal controls in these ever-changing times. And so this is a little graphic here to show what extent did pandemic-related factors contribute to occupational frauds. And again, I think you can see the different ranges, whether it was significant, moderate, slight. But the main takeaway from this is that in many cases, there was at least some impact to things like organizational staffing changes, the shift to remote work, operational process changes, internal control changes. It blows my mind how many times I've walked into clients post-pandemic and asked what changes they've had in their internal controls, knowing full well that they've got some folks that at least on a part-time basis are working remotely, and or that they've had periods of vacancy in key financial roles because they've had individuals leave and they went months without being able to fill that role. And the response I get is, nope, there haven't been any changes. That's probably not likely if you have a situation where you've had a vacancy, or you've had, if you've provided employees the opportunities to work from home or work remotely, because that does change the landscape a little bit. And so we can go ahead and advance to the next slide, Christina. But some things to keep in mind, specifically to the technology and labor force changes. Perhaps you're now receiving electronic invoices and other records. Maybe you still get some mailed, but I know a lot of my clients have started to receive invoices electronically. The controls in place for that are probably a lot different than when you would receive a paper invoice in the mail, and maybe, you had an invoice that you would stamp to where you would approve it, and then maybe another stamp where you would, put a box on and write what GL code it had to go to when it ultimately made its way to the accounting department. And then there might be a separate approval for ultimately pay, or when the invoice ultimately gets paid. Maybe now they're being emailed. And so making sure that your controls that are in place are appropriate, and that if you have any related policies and procedures associated with that, please make sure that they're updated to reflect the changes in how you're receiving some of these documents that you're ultimately responsible for approving as part of these key internal control processes. If the people involved in the approval are working remotely, what does that approval look like? Is it an email? Are they able to digitally sign an invoice in like PDF, Adobe? I haven't necessarily seen consistency there. And so just making sure that you've got that key control in place and that the documentation is consistent across the board. We also want to make sure that access to accounting records is appropriate. Again, we talked about how that access is a key internal control. So when you have remote workers, yeah, they're going to need access to things to be able to do their jobs, but is it the right access? Do they have access only to the critical pieces of software that they need to do their jobs? Nothing more, nothing less. And again, just circling back to the documentation considerations, because again, for those of you that are audited, you know that we're going to come in as your auditors and ask you to document a lot of these controls and show us these invoices that have been approved, or cash receipts, making sure that they were properly posted. And so just making sure that all of these controls are not only being done and performed, but that they're being properly documented consistently as a key factor that we want to keep in mind here. And then I do see one more poll question, if everyone would make sure that you answer that for me. Lastly, I just want to talk about controls during, the time we call the Great Resignation. I don't know that I have many, if any, employee or clients rather, that have not gone through a period where they've had, again, some holes in their personnel, whether it's financial and accounting folks, operational staff. But again, what do those internal controls look like during these vacancy periods? This is, again, where having those written policies, manuals, procedures are crucial, and making sure that they're updated sufficiently and regularly. Because not only does that help to document what changes you may have made, but that's also going to be a training mechanism when you ultimately do hire a new individual, to help get them acclimated to what the processes are that are in place, and ultimately what controls they may be responsible for overseeing and adhering to. Again, the access controls. So if you have a chief financial officer, for example, that resigned, or a vacant position, who's going to have access to provide the accountant to do the accounting records when they're gone? Does that default to a controller? Does that, do you outsource that work? But just, again, making sure that you've got the right people having the right access, both physical access and logical access, and having a backup during periods of position vacancy. And, that may not even be vacancy due to people resigning. It could even be vacation. So, wanting to make sure that you've got controls in place to still be able to be working properly when people take vacations. And that involves having a sort of a backup individual who can be responsible for doing all of that work while someone's out. I'll tell you right now too, a great control to have in place is to have somebody who's not typically involved with the day-to-day accounting work stepping in to do the work while an individual's on vacation, because we have seen situations, and there are plenty of fraud cases that show that where fraud does tend to occur is when you have an individual who refuses to take time off and refuses to take vacation, where sometimes you end up finding things. And again, it may not even be fraud. It could just be errors, because it's when you start to ask questions is when you put someone in there that knows enough to be able to perform the work, but that hasn't been involved in doing it day to day previously, that could at least start to ask the questions of, well, why was this done like this? That can be a great control as well. And also the use of service organizations. Many of your organizations are likely already utilizing them, at the very least, perhaps in payroll. But certainly if you're having difficulty in filling positions internally and you need to maintain the proper internal controls, having a service organization to fill in things like billing, investment management, all of those things that can certainly, those service organizations can certainly help as well. And so with that, I will turn it over to any further questions that may have come up. And then once we get through questions, I believe it will be time for a break.
I just saw one question come through, and again, it was before you addressed it, but just in case you have any additional insights, any suggestions for segregation of duties when you only have one person in the organization that handles AR, AP, QuickBooks, purchasing, etc.? We do use 2 signatures on all checks and withdrawals and have another employee do bank deposits.
Yeah, so it sounds to me like you guys are in the right, you're doing things correctly with the staff that you have available. The 2 signatures on all checks is going to be, that's going to be at least your second set of eyes on the cash disbursement process. Again, to the extent that maybe you have a board member that can serve in an oversight role, and that's not to say for every single AR and AP transaction, but just more of the oversight role. And again, maybe that's just reviewing monthly financial reports, reviewing journal entries for reasonableness, especially as they relate to those specific aspects of your organizations. It really just boils down to having another set of eyes to the extent possible. But it sounds like having a different employee doing the bank deposits and the 2 check signatures are absolutely some good mitigating controls in place. So it sounds like you're at least on the right track.